In early 2026, the individuals who designed the architecture of the modern internet began relocating their families and their assets. Google co-founders Larry Page and Sergey Brin, along with prominent venture capitalists like Peter Thiel, began systematically untangling themselves from the state of California. The mechanical reality of this exit is documented in the paperwork. Over 45 California-based LLCs connected to these figures were shuttered, replaced by the acquisition of multi-million-dollar estates in Florida neighborhoods like Miami's Coconut Grove. While Miami captures the domestic fraction of this movement, a global shift is occurring across the Atlantic. International ultra-high net worth capital is currently flowing into the United Arab Emirates at a rate that has luxury real estate offices in Dubai operating at capacity. The Western financial press largely characterizes this migration as a standard tax avoidance play. The prevailing assumption is that billionaires are fleeing California's 13.3% income tax rate to park their assets in an offshore, zero-tax sanctuary. But treating Dubai as a passive vault misreads the data. The city has engineered a specific ecosystem designed to attract active operating capital. The founders moving here are seeking regulatory arbitrage and geopolitical neutrality to continue building their enterprises. There is a sharp distinction between a jurisdiction designed for asset concealment and one designed for enterprise creation. Passive tax havens like the Cayman Islands attract idle money. The capital moving today belongs to working founders who require infrastructure, deal flow, and talent. Operating capital requires a high-velocity environment. These founders are selecting jurisdictions that function as strategic launchpads, prioritizing execution speed over simple asset protection. This attraction strategy relies on three distinct structural pillars.
First, a frictionless baseline for taxation. Second, direct access to massive pools of institutional capital. And third, neutral regulation that bridges divided global markets. To understand why these founders are running to the desert, we have to examine the mathematical reality pushing them out of Silicon Valley. California has historically maintained the highest income tax rate in the United States. Because the state offers no capital gains break, a founder selling equity could face a combined federal and state tax burden exceeding 37%. For decades, returns generated by the Silicon Valley innovation engine were so extraordinary that founders accepted this friction as the standard cost of doing business. Then, late in 2025, the calculus broke. State legislators proposed a one-time 5% wealth tax levied against every California resident with a net worth exceeding $1 billion. This legislation did not target realized cash gains or annual income. It targeted total accumulated paper wealth. This chart visualizes the mathematical trap for a startup founder. If your net worth is entirely bound up in illiquid, unsold private company stock, you cannot access cash to pay a wealth tax. The only mechanism to satisfy the state's liability is the forced liquidation of your own equity, eroding control of the company you built. For founders scaling hardware or defense technology, the stakes were suddenly existential. Founders in these sectors warned the proposed tax would force them to sell significant portions of their companies prematurely just to cover the bill. The wealth tax proposal accelerated a migration already driven by housing costs and regulatory complexity. It shifted the cost of remaining in California from a manageable burden to a threat to company control. Against California's friction, Dubai offers a stark mathematical contrast, beginning with a 0% income tax rate. While California proposes levies on total wealth, Dubai provides an absolute absence of taxation, zero capital gains, dividends, and inheritance tax. This frictionless financial baseline operates within a highly functional civic environment. The city has deployed tokenized real estate certificates and blockchain-based property transfers, proving that their infrastructure supports live, modern financial products. But eliminating taxes only retains wealth. To attract active operators, a jurisdiction must offer access to new capital. The UAE controls an immense concentration of global liquidity. Its sovereign wealth funds manage approximately 40% of all sovereign wealth assets on Earth. Funds like the Abu Dhabi Investment Authority and Mubadala do not sit idle. They actively co-invest and catalyze growth, allowing founders to bypass the bureaucratic friction and prolonged timelines typical of Western venture capital networks. Relocating to Dubai secures strategic geographic proximity.
founders are positioning themselves directly adjacent to the most aggressive, deployable institutional capital currently operating in the global market. An active yet frequently underreported segment of this migration consists of cryptocurrency and digital asset founders. While the United States engaged in years of regulatory ambiguity regarding digital assets, Dubai manufactured legal certainty. In 2022, they launched the Virtual Assets Regulatory Authority, creating the world's first dedicated regulator for crypto businesses, allowing them to raise capital and list products openly. When a few high-net-worth crypto founders relocated to take advantage of this clarity, they triggered a clustering of network capital. The social and network capital followed the legal framework, creating a localized density of talent that now acts as its own gravitational pull. Zooming out from the digital asset sector, the broadest macro factor driving the migration of operating capital is the requirement for geopolitical neutrality. As economic rivalries intensify between the US and China, and Western sanctions fracture the global financial system, executing cross-block transactions in traditional hubs like New York or London has become severely constrained. This diagram illustrates Dubai's deliberate positioning as a neutral bridge. The jurisdiction maintains relationships across all competing blocks, allowing Indian family offices, Chinese state funds, and American operators to legally structure joint ventures together under English common law. In a bifurcating global economy, the most valuable financial domiciles are those that maintain total strategic independence and possess the ability to bridge opposing superpowers. The data strips the anecdotal bias from this migration. Between 2014 and 2024, Dubai's millionaire population grew by 102%, narrowly outpacing the 98% growth rate of the combined Silicon Valley and San Francisco areas. However, evaluating this strictly by the departure of high-profile billionaires ignores a significant counterthesis. Silicon Valley retains immense structural power, and many elite allocators are actively choosing to remain. Executives like NVIDIA CEO Jensen Huang argue that taxes are secondary to their operational business requirements. The density of engineering expertise and specialized talent available in California cannot be instantly replicated by purchasing real estate in a new jurisdiction. Furthermore, the American innovation machine is fed by a 70-year institutional pipeline. Research universities like Stanford and Caltech provide a continuous feed of highly specialized researchers that currently has no equivalent in the UAE. The critical distinction lies in the stage of wealth creation. The individuals leaving for Dubai are largely those managing wealth that has already been generated. The next generation of founders, attempting to build the next trillion-dollar company, still heavily relies on California's entrenched talent density. The departure of these established founders represents a generational erosion of the American tech economy. As winners leave to protect their capital, they extract the seed funding and mentorship networks that sustain the ecosystem's long-term health. The physical reality of the migration is recorded in tax filings, visa applications, and LLC closures occurring right now. The money is moving. The ultimate test is whether this concentration of capital and human ambition will produce technological innovation or merely result in highly efficient wealth management. Silicon Valley achieved global dominance by providing the exact right legal and financial conditions at the exact right time for the people capable of building the internet. Dubai has engineered its entire society on the premise that it now holds those conditions. Judging by the current global flow of operating capital, that bet is already paying off.